You might hear some people say that banks don't create money, they just create credit. This response often comes from mainstream economists, civil servants, and others who deny that banks now create much of our money supply. So let me show you why the numbers in your account that the banks create should be thought of as money and not just credit. First, there should be no doubt that the money the banks create is credit. The borrower receives the money on credit, or in other words, as a loan, and promises to pay it back. This is what makes it credit, because the money that the banks create is not already existing money that they literally lend out. The process of so-called lending is often more accurately described as credit creation. So, we are not disputing that the money the banks create is in fact credit. Instead, we're making the point that this credit is also, basically, money. After all, $1 in your bank account is worth the same as $1 in cash, even in a crisis, thanks to public support. This relationship of equal value between bank deposits and cash is called par. Now, if the money that the banks create is really just an IOU from the bank to their customer, as we explained earlier, why is the bank's promise to pay cash as good as cash itself? Well, the government has a program called the Federal Deposit Insurance Corporation, or FDIC. This program promises to repay you up to at least $250,000 of your account balance if your bank fails and can't pay you some or all of the money it owes you. This guarantee is supposed to be funded by contributions pooled together by the banks. But if the contributions from the banks aren't enough, then the Treasury provides a line of credit to cover the rest of it. Think about what that means for a second. This guarantee means that it is not just a bank-funded insurance pool standing behind the value of your deposits, but the full faith and credit of the United States government. This is why $1 in your bank account, at least up to the FDIC limit, is always worth the same as $1 in cash, even if the bank creates that account balance when it makes a loan. This also means the bank deposits are worth the same as cash, even during a crisis when other debts that aren't publicly backed lose value on the market due to the increased chance they won't be repaid. This publicly enforced par convertibility relationship between cash and bank deposits is why bank deposits are essentially as money-like as cash, and therefore should be thought of as money. So, it's very much appropriate that central bank documents often refer to the fact that banks create much of the money in the economy. Now, why is this important? Well, while we often hear economists, financial institutions, and politicians warning of the danger of inflation due to government money creation, we rarely, if ever, hear anyone in the media mention the fact that banks create a similarly large share of our money supply as the government does, or even that banks create money at all. If rising inflation at some point means we should cut back on money creation, which would you prefer we cut back on? Money creation through public spending, or money creation through bank lending? This is the question that never arises if we don't recognize that banks create money. And not only that, they do it with public support. So, would you generally prefer money creation fund our government and then be left to circulate as our medium of exchange? Or would you prefer that we borrow that money into existence over and over again, constantly paying it back to the banks with interest? While some may normally be reluctant to place restrictions on private sector activity, it's important to remember that these banks rely on our public support to prop up their ability to profit from creating our money. Without public support, it would be much harder for banks to pull off making loans without first actually having the money they lend out. Public support is what moved banking out of the era of frequent panics and bank failures, which often caused contagion and led to economic collapse and depression. It's also what made it so that the numbers in your bank account aren't merely as good as the bank's ability to pay you back, but as good as the government's ability to pay you back. Since the government is able to literally print cash, this guarantee is as good as it gets. The bottom line is that you have to first recognize that public support is giving the banks the power to create a kind of money that's as good as cash before you can realize its implications. The first implication is that the banks are essentially allocating public funds when they make loans. Therefore, we, the public, should be able to determine what uses of these funds are publicly approved. The second implication is that restricting this use of public funds to publicly approved purposes would reduce money creation through bank lending and provide an alternate tool for checking inflation. This tool would allow us to impose the burden of checking inflation on the banks who have long quietly created much of our money for uses with little public interest justification, rather than the general public. The ability to create money requires public support. Let's make sure this support is used in the interest of the public. Our Money is campaigning to change the way money is created, and we need you to get involved. Share this video, join our campaign at ourmoneyus.org/signup to stay informed of our campaign efforts, and follow us on Facebook, Instagram, and Twitter at Our Money US.